The local branch manager thought he was holding a useless scrap of paper from a broken old man, completely oblivious to the fact that this single decision would spark a multimillion-dollar systemic collapse. When you think of a bank failure, you think of bad investments or massive stock market crashes, but the destruction of Midland Trust didn't start on Wall Street. It started in a dusty county clerk's office and ended when a single $43 transaction was arrogantly denied. Within 72 hours, the entire executive board would watch their personal and corporate wealth vanish behind an unyielding, court-ordered digital firewall they couldn't breach. To understand how a multi-state banking conglomerate could be brought to its knees by a local cattleman, you have to look past the glass towers and down into the soil of the valley itself. Arthur Vance was not a wealthy man by modern corporate standards, but he was a wealthy man by the metrics that actually matter in the West. He owned 3,000 acres of deeded prairie land, a territory his grandfather had cleared when the state was mostly wilderness. Arthur's hands were mapped with deep, permanent creases of engine oil and calluses, the physical ledger of 50 years spent pulling calves out of freezing mud and fixing barbed wire fences in July heat. He wasn't a man who understood algorithms, but he understood contracts, and more importantly, he understood the promises people made when they signed them. For 4 decades, Arthur had operated his ranch through a standard agricultural operating account with Midland Trust. In the farming community, these relationships are the lifeblood of survival. You borrow against the autumn harvest to buy seed and diesel in the spring, and the bank acts as your financial partner. It was a symbiotic ecosystem that worked perfectly until the original founders of Midland Trust retired, selling their shares to a private equity firm based out of Chicago. The new ownership didn't care about the personal handshakes or the multi-generational loyalty that kept the valley alive. They looked at the balance sheets through the cold lens of risk assessment and automated profit margins, deciding almost immediately that small-scale agricultural lending was an outdated liability. The new executives wanted the land, not the cattle. The valley was expanding, suburban developments were creeping closer to the eastern ridge, and Arthur's 3,000 acres sat directly in the crosshairs of a major commercial real estate project. The corporate office began a systematic campaign of subtle financial strangulation, raising administrative fees, tightening credit lines, and strictly enforcing obscure regulatory clauses to force the older ranchers into foreclosure. They wanted Arthur to default, because a default would allow them to seize his prime acreage for pennies on the dollar through a prearranged liquidation clause in his old development bonds. On a Tuesday afternoon, Arthur walked into the polished, newly renovated branch of Midland Trust to settle a routine statutory maintenance fee on his water rights. It was a minor obligation, a mere $43 required to keep his irrigation channels registered with the state board, a payment that had to be routed through the bank holding his primary agricultural deed. Arthur presented a manual countercheck drawn from his auxiliary equipment fund. The account possessed more than enough collateral to cover the tiny amount, but the system flagged the transaction because the new corporate policy had quietly classified Arthur's specific account tier as inactive pending review. The young assistant manager, a man brought in from the regional corporate office who wore a crisp suit and knew nothing about irrigation laws, looked at the check with open disdain. He didn't see a foundational pillar of the county's water infrastructure. He saw an old man trying to bypass a newly instituted corporate freeze. He pushed the paper back across the marble counter, informing Arthur that the bank was no longer honoring manual drafts from his specific trust classification without a formal administrative audit, a process that would take a minimum of 30 business days. Arthur tried to explain that if the $43 wasn't processed and time-stamped by the state clerk by Thursday at midnight, his historic water rights would technically lapse, allowing the bank's development subsidiary to claim top-tier water access for their commercial projects. The manager simply smiled, adjusted his tie, and stated that corporate guidelines were absolute. The check was stamped with a bold, red, transaction refused, ink mark and handed back to the rancher. Arthur took the paper, folded it carefully, placed it into his flannel shirt pocket, and walked out without saying another word. The branch staff assumed they had won a quiet, bureaucratic victory. They had no idea that Arthur's quiet demeanor wasn't submission, it was the calm before a devastating legal storm. The corporate office viewed Arthur's quiet departure as a closed file, but the old rancher drove straight to a small, wood-paneled office situated behind the county courthouse. This was the practice of Thomas Miller, a lawyer whose family had handled land titles and water rights in the valley for just as long as the Vances had raised cattle. Thomas wasn't a corporate litigator in a tailored suit, but he possessed an encyclopedic knowledge of the state's agricultural statutes, laws written a century ago to protect food producers from the predatory tactics of expanding railroad monopolies and banking syndicates. Arthur sat heavily in the leather chair, pulled the red-stamped $43 check from his shirt pocket, and laid it on the desk alongside a faded, ribbon-bound document from 1952. This document was the original master credit agreement between the Vance Ranch and the founding directors of Midland Trust. When the Chicago private equity firm bought out the local bank, their legal team had systematically reviewed the active digital files, but they had completely overlooked the physical archives containing the binding, foundational covenants of the oldest agricultural accounts. Thomas put on his reading glasses and studied the two documents side by side. A slow, grim smile began to form on the attorney's face as he realized exactly what the branch manager had done. By stamping that specific check with a formal rejection mark, the bank hadn't just inconvenienced an old man, they had committed a material, systemic breach of a highly protected statutory contract. Under the state's Agricultural Credit Protection Act of 1934, a law that remained fully active on the books, any chartered financial institution holding a primary mortgage on agricultural land was legally obligated to honor all drafts related to state infrastructure maintenance, including water and irrigation fees. The statute was incredibly clear and unforgiving. It was designed during the Dust Bowl era to prevent banks from intentionally forcing farmers into foreclosure by withholding tiny operational payments. The law stated that if an institution maliciously or through gross negligence refused to honor a valid draft intended for state regulatory fees, the account holder was granted an automatic statutory lien against the bank's own operational assets. Furthermore, because Midland Trust had integrated its local branches directly into its corporate structure rather than operating them as separate legal subsidiaries, any liability incurred by the local branch applied directly to the parent corporation and its executive officers. Thomas looked up from the papers, his eyes locked onto Arthur. He explained that the bank's arrogance had just handed them a legal weapon of absolute destruction. The modern executives who ran Midland Trust from their high-rise offices in Chicago viewed themselves as entirely insulated from the problems of rural ranchers. They operated through layers of corporate shielding, believing that any legal dispute would simply drag on in federal court for years until the plaintiff ran out of money. But the 1934 statute bypassed the standard, slow-moving civil litigation process entirely. It allowed for an expedited, ex parte administrative filing, a legal maneuver conducted without notifying the defending party beforehand, specifically designed to stop financial fraud before assets could be hidden. Arthur nodded slowly, his voice calm but steady. He told Thomas to execute the full scope of the law. They spent the next 12 hours meticulously preparing the administrative affidavit, attaching the certified copy of the 1952 covenant, the proof of Arthur's pristine credit history, and the physical $43 check bearing the bank's own red rejection stamp. They didn't file the paperwork in the federal system where corporate attorneys could stall it, they submitted it directly to the State Department of Financial Regulation and the regional circuit court clerk, backed by a mandatory statutory bond that Arthur secured by using his cattle herd as collateral. By Thursday afternoon, while the regional branch manager was congratulating himself on clearing the path for the real estate development group to seize the Vance water rights, a quiet state administrative judge was reviewing Thomas Miller's filing. The documentation was flawless. The breach was undeniable, visible in the bold red ink of the bank's own stamp. Under the strict wording of the historical agricultural protection laws. The judge had no discretion. The bank had violated its fiduciary duty to a primary food producer, threatening the agricultural stability of the district. The judge signed the expedited executive enforcement order at exactly 4 o'clock on Thursday evening. The order didn't just request an explanation from Midland Trust, nor did it schedule a hearing for the following month. It invoked the state's emergency stabilization powers, directing the state banking authority and the regional U.S. Marshal Service to secure assets equivalent to the maximum statutory penalty for systemic mortgage fraud, a penalty calculated based on a percentage of the bank's total executive asset pool. The trap was set, and the corporate executives in Chicago were completely unaware that their entire financial world was about to be plunged into absolute darkness. On Friday morning, the executive floor of Midland Trust's corporate headquarters in Chicago was operating with its usual sterile efficiency. Chief Executive Officer Richard Vance, no relation to Arthur, was reviewing the final projections for the Valley Residential Development Project. To him, the ranchers were just names on a spreadsheet, minor obstacles to be cleared away by administrative attrition. The spreadsheets indicated that within 90 days, a cascade of engineered defaults would trigger, allowing the bank to absorb the historic water rights and liquidate the surrounding land parcels. The first indication that something had gone catastrophically wrong did not come from a process server or a formal legal notice. It came at precisely 9:15, when the chief financial officer's personal assistant tried to process the biweekly executive bonus distribution. The automated clearinghouse system, which usually handled millions of dollars in executive compensation with a single keystroke, threw a fatal system error code. The message on the screen was unfamiliar and highly unusual. Account status restricted, external administrative sovereign hold. Assuming it was a temporary software glitch resulting from a recent server migration, the IT department was summoned to bypass the security wall. But as the technicians began tracing the digital block, the error code began spreading across the internal network like a rapid contagion. It wasn't just the bonus distribution account that was locked. Within 30 minutes, the primary operational accounts for every single member of the executive committee began going dark one by one. Personal debit cards were declined at the ground floor coffee shop. Corporate credit lines used for institutional liquidity showed zero available balance. By mid-morning, a wave of low-voltage panic began vibrating through the executive offices. Richard Vance called an emergency meeting in the main boardroom, demanding to know why the bank's internal capital accounts were throwing administrative lock codes. The answer arrived not from their technical team, but from the bank's general counsel, who entered the room looking visibly shaken, clutching a stack of papers that had just been delivered via courier from the State Department of Financial Regulation. The general counsel laid the documents on the glass boardroom table, explaining to the assembled executives that they were not dealing with a cyber attack or a system failure. They were under a comprehensive, state-enforced emergency asset freeze. The filing originated from a small agricultural county 300 miles away, invoked under a fully active, historic emergency banking statute. The corporate legal team had spent decades building sophisticated corporate structures to shield the executive board from standard civil lawsuits, but this specific statutory lien bypassed every single layer of their modern legal defense. The executives listened in absolute disbelief as the general counsel explained the mechanics of the trap. By intentionally and falsely denying a valid $43 operational draft for historic water rights, the local branch had triggered an automatic statutory violation of a protected agricultural covenant. Under the 1934 Act, the penalty for an intentional, bad faith denial that threatened a region's agricultural infrastructure wasn't a standard fine. It was an immediate, mandatory freeze of all liquid assets belonging to the entity and its principal officers, held in escrow until a formal state tribunal could verify the extent of the systemic damage. Richard Vance slammed his hand on the table, demanding to know how a $43 dispute could legally justify freezing hundreds of millions of dollars in executive capital. He ordered the legal team to file an immediate injunction in federal court to throw out the administrative order. But the general counsel shook his head, pointing to a specific clause in the state constitution. Because the freeze was executed under an emergency agricultural preservation mandate, federal courts had no immediate jurisdiction over the state's sovereign banking police powers until all local administrative remedies had been completely exhausted. The reality of their situation began to settle over the room like a cold fog. The bank's internal ledger system was hardwired into the central banking authority. Once the state judge's electronic enforcement order was uploaded into the regulatory clearinghouse, the restriction was absolute. The executives could not move money, they could not pay their staff, they could not access their personal checking accounts, and they could not use corporate funds to hire outside legal counsel. The very system they had used to squeeze the local ranchers had been turned into a digital cage, and the key was held by an old man in a dusty flannel shirt who was currently sitting on his porch, watching his cattle graze. By 2 o'clock on Friday afternoon, the atmosphere inside Midland Trust's executive suite had devolved from controlled panic into absolute, unmitigated chaos. The timing of the administrative order was calculated with lethal precision by Thomas Miller. By securing the judge's signature late Thursday and ensuring the digital upload hit the central clearinghouse on Friday morning, the legal team had effectively trapped the bank over a weekend. In the banking industry, a weekend freeze is a death sentence. The regulatory bodies are closed, the courts cannot hear emergency appeals until Monday morning, and the financial markets have 48 hours to speculate on an institution's sudden instability. The internal communications network was lighting up with frantic inquiries from regional branches across 3 states. It wasn't just the executive accounts that were locked now, the corporate treasury accounts used to settle daily institutional balances were completely frozen. If a bank cannot clear its daily balances with the central clearinghouse by the 4 o'clock closing bell, it is automatically flagged as insolvent, an event that triggers an immediate federal audit and an inevitable run on the bank by panicked depositors. Richard Vance sat behind his mahogany desk, staring at his personal tablet. The screen displayed his private wealth portfolio, the accumulation of 25 years of corporate rating, stock options, and aggressive asset liquidations. The balance read over $12 million, but directly adjacent to the figure was a small, glowing red padlock icon with the text, "Assets sequestered by court order, case reference AG, 1934-089. He tried to use his personal black card to arrange a private charter flight to handle an out-of-state client emergency. The transaction was instantly declined for insufficient authorization. The man who controlled a multi-billion-dollar financial institution could not even buy a sandwich from the cafeteria downstairs. The chief financial officer burst into the office without knocking, his face pale and his collar unbuttoned. He informed Vance that the news of the executive account freeze had leaked to the financial press. A local reporter in the rancher's home county had spotted the public docket entry at the courthouse and posted it online. Within 30 minutes, the headline had been picked up by major financial networks: Midland Trust Executive Board frozen out amid historic agricultural fraud allegations. Shareholders were dumping stock in the after-hours market, and the bank's valuation was dropping by millions of dollars every tick of the clock. "We need to settle this right now," the CFO stammered, leaning over the desk. "Authorize a wire transfer for whatever that old man wants. Give him $1 million. Give him $5 million. Just get that red lock off our clearinghouse portal before the 4 o'clock settlement deadline." The general counsel, who had followed the CFO into the office, let out a dry, hollow laugh. "With what money? Every corporate treasury account we own is under the jurisdiction of the state regulator. We cannot authorize a wire transfer of 5 cents, let alone $5 million. The system is entirely locked. The only way to lift the administrative hold is for the original plaintiff, Arthur Vance, to sign a formal statutory release form in front of the regional circuit clerk." Richard Vance realized, for the first time in his career, that his corporate power was completely useless. He looked at the clock on his wall, 3:15. He had exactly 45 minutes before the clearinghouse bell would ring, cementing the bank's technical insolvency. He grabbed his desk phone, dialed the number for the local Valley branch, and commanded the terrified branch manager to get on a radio or drive out to the Vance ranch immediately. When the branch manager's luxury sedan tore up the gravel driveway of the Vance property, kicking up a massive cloud of dust, he found Arthur exactly where he expected him to be. The old rancher was working on the hydraulic line of his old John Deere tractor, his hands covered in grease. The branch manager scrambled out of the car, his expensive leather shoes sinking into the mud, clutching a pristine corporate settlement agreement that had been frantically drafted by the remaining local staff. The manager was trembling as he approached the tractor, his voice cracking with desperation. He offered Arthur a complete waiver of all future administrative fees, a permanent, guaranteed extension of his agricultural credit line at 0% interest, and a direct corporate check for $500,000 in exchange for an immediate signature on the release document. Arthur didn't look up from his wrench. He slowly tightened the nut on the hydraulic valve, wiped his hands on a rag, and looked down at the sweating executive. He told the manager that on Tuesday, $43 was an absolute corporate impossibility according to their guidelines. He noted that it was funny how corporate guidelines seemed to change so quickly when the shoes were on the other feet. Arthur then calmly climbed up into the tractor cab, started the diesel engine with a loud roar, and drove out into the north pasture, leaving the branch manager standing alone in the dirt as the clock struck exactly 4 o'clock. When Monday morning arrived, the glass tower of Midland Trust did not open for standard business. The 4 o'clock clearinghouse deadline on Friday had passed without a settlement, triggering an automatic regulatory alert. By 7 a.m., representatives from the State Department of Financial Regulation, flanked by forensic auditors, had established a command center inside the Chicago boardroom. The executives who had spent years manipulating balance sheets to squeeze small landowners were completely displaced, forced to sit in the waiting area while state officials sifted through their operational data to ensure the institution was still stable enough to protect its ordinary depositors. The internal data revealed a dark reality that the executive board had successfully hidden from public view for over a year. The rejection of Arthur's $43 check wasn't just an isolated case of administrative arrogance, it was part of a documented, systematic program designed to trigger artificial defaults across more than 40 historic family farms in the valley. The forensic auditors found internal emails explicitly detailing the strategy to seize the region's ancient water rights to artificially inflate the valuation of the bank's commercial real estate subsidiary ahead of a planned public offering. Because Thomas Miller's administrative filing had been executed under the 1934 Emergency Agricultural Preservation Mandate, the state regulators were legally empowered to expand their investigation into a comprehensive audit of the bank's entire agricultural portfolio. The predatory scheme was laid bare in black and white. What began as a local property dispute had evolved into a massive, state-level regulatory scandal. The Chicago private equity firm faced not just the loss of their development project, but the total revocation of their state banking charter. At 10:30 a.m., a defeated and exhausted Richard Vance, accompanied by the bank's remaining legal counsel, arrived at Thomas Miller's modest office in the valley. There were no cameras, no corporate press releases, and no layers of security. Arthur Vance sat at the round wooden table, still wearing his work clothes, looking completely unbothered by the financial storm he had unleashed across the country. The general counsel laid out a final, non-negotiable master settlement agreement. The terms were absolute surrender. Midland Trust agreed to dissolve its commercial real estate subsidiary entirely, returning all seized land parcels in the valley to their original owners. Furthermore, the bank was required to establish a permanent, legally protected $10 million agricultural trust fund, managed by a local board of trustees, to guarantee that no family farm in the district could ever be subjected to predatory fee structures or artificial defaults again. Finally, Richard Vance pushed a single piece of paper toward Arthur. It was a certified cashier's check, issued directly by the state regulatory authority from the bank's sequestered funds. The amount written on the check was exactly $43. Arthur picked up the paper, inspected the numbers carefully, and allowed a brief smile to show beneath his gray mustache. He signed his name to the statutory release form, officially lifting the administrative sovereign hold on the executive accounts. Within minutes, the electronic padlocks vanished from the corporate servers in Chicago, but the damage to the executive board's reputation and power was permanent. The private equity firm was forced to sell its shares at a massive loss, and Richard Vance was permanently barred by state regulators from ever serving as an officer of a financial institution again. The story of the $43 check became a legendary cautionary tale within the banking industry, a stark reminder that the laws of the land are not just tools for the powerful to manipulate. The historical statutes written to protect the people who work the soil remain active, waiting for those with the patience and courage to invoke them. Arthur Vance drove back to his ranch that afternoon, stopped by the county clerk's office to pay his water rights fee in cash, and went straight back to fixing his tractor. He had protected his land, saved his neighbors, and taught the largest financial institution in the state a lesson they would never forget: never underestimate a man who understands the value of a promise.